Okay, welcome everyone to the second of 5 masterclass sessions on Social Security from Income Lab, giving everybody some time to get in the room before we kick off the presentation. This room must have big doors because people are piling in. While we're waiting, if you want to drop in the chat where you're calling in from, it's always fun to see. I'm in Golden, Colorado this morning, or this afternoon, I guess now. Oh yeah, all over the place. Awesome. Nobody out of the country yet that I see. All right, we'll get some of the housekeeping taken care of as the rest of the people. Oh, Kuala Lumpur. Okay, I think we might have a winner for the farthest away. So a little housekeeping today. The second of our master classes is on taxation of Social Security. Huge topic, super interesting, and people just have been asking for this kind of thing. So we're gonna dive in with Michael Kothakota, who is professor of financial planning at Columbia and NYU, and also runs Wolfbridge Wealth. And very, very thankful for Mike helping us out today. I'll be here to kind of monitor the Q&A and maybe interject here or there if I have something interesting to say, or maybe even if I don't. For those of you who missed last week, or even if you caught it, we did have a session on the underappreciated risks of Social Security claiming. There is a recording of that available if you want to check it out. And also, I believe we distribute the slides from it. Today, as I said, we'll be talking about Social Security, and we have 3 more sessions, one next week, one the following week, and then we skip a week and we wrap up on the 26th. So next week, we'll be talking about Social Security planning with spousal benefits, survivor benefits, and divorce. Probably one of the most complicated areas of Social Security, so be ready to roll up your sleeves. Mike is going to help us out with that one as well as Dylan Cobb. And then on the 12th, we'll have a panel discussion on the psychology of Social Security claiming. That one's going to be great. I'm really looking forward to that. And then we'll wrap up with talking to clients and prospects about Social Security. So you got a summer of Social Security here ahead of you. Let's see some of the housekeeping items. So this session does qualify for CFP CE. So you got to make sure that you are on here for 50 minutes or more. No, your AI note taker does not count. So it's actually got to be you. There will be a post-webinar survey where you'll have an opportunity to give us your CFP ID. And if you have a question, please drop it into the Q&A, which is not the same as the chat. It's just really hard. Chat's great. You can chat with each other, but I'm only going to be monitoring the Q&A, or I only promise to monitor the Q&A. I'll try to jump over to chat occasionally, but it's really hard to follow and answer all those questions. And if you see a question that you really like and want to have answered, please upvote it. So I think that's just clicking on the little thumbs up, and that way we'll have some idea of which questions we want to get to first, because usually we have about 10 times as many questions as we can handle. So I think that wraps up my housekeeping, and I'll turn it over to you, Mike. Thanks very much.
Thanks, Justin. I appreciate it. Welcome to the second week. There's going to be a few things about this particular session that are kind of assumed if you've watched the first session. But if you need any clarification, feel free to put it in the Q&A, or actually put it in the Q&A. It'd probably be a little bit easier. It sounds like that's going to be a little bit easier. This is our general agenda today. I'm gonna we went through the introduction already, and then we'll go through understanding like the basics of Social Security taxation. With that, we'll talk about the recent changes. Maybe you got an email from Social Security about the OBBA. So we'll talk about some of the changes there and what those actually mean, as opposed to what maybe some of your clients may have heard about. I'm going to discuss some state differences in Social Security taxation. So most states don't tax Social Security, but there are some differences. And then we'll go through some planning scenarios and then answer any questions that you have. Hopefully we'll have time to get through all of these things. These slides will be available to you. There's a couple links in there that could be useful, especially for those of you who are in Utah. All right. Okay, so the first thing that we kind of need to talk about is that Social Security is not taxed like most things are taxed. It's taxed based on what's called provisional income, which we'll get to in a second. But this table essentially represents the different thresholds. So, as you can tell from this particular table, if your Social Security is less than $25,000, or if your provisional income is less than $25,000, you're actually not going to get taxed on your Social Security at all. So none of your Social Security will be taxable. That moves up as you move up in income ranges. So from 25,000 to 34,000, about 50% of your benefits can be taxed. So how would that work? So if you make $30,000, your provisional income is $30,000, and that's entirely Social Security, then $15,000 of your Social Security benefits would be taxed. And then over 34,000, it's going to be 85% of your benefits that can be taxed. And you can see this kind of plays out in the joint area. There is no head of household filing status for this. It is assumed that if you're of retirement age, that you may not be a head of household. We're talking about the divorce session next week. I can tell you there are a number of people in their 60s, even collecting Social Security, that can actually claim head of household status. So I think this is a little bit of a miss from the federal government. Okay, so what is provisional income? So it's called combined income or provisional income, depending on who you talk to. Essentially, it's a formula of the income from all sources of taxable type income. Now, so that includes things like your 401ks, IRAs, pensions, et cetera, any non-taxable interest, but not from Roth IRAs. So key there is it's not going to be from Roth IRAs. But also key is wages. So if you think about whether you're working part-time or not, maybe you have other sources of income that could be considered wages. That is typically going to be included in combined income. All right, so here's just like a very quick example of how you would calculate combined income. So we've got Barb. She's got $32,000 in Social Security income, $1,000 in dividend income, and then $40,000 in Roth IRA distribution. So what would her combined income be in this case? Right, so her income appears to be $73,000, but for purposes of Social Security taxation, it's not. Right, so if we go back here, we can kind of see that she's got basically $33,000 is what her combined income is, and then she's going to get taxed on that. So it's going to be her taxable income is going to be $17,000, but she's going to pay 0% on her Social Security income. All right. Anybody get this email? So here I got this email July 3rd. So you can see here that Social Security, this is from the Social Security Administration, applauds the passage of legislation providing historic tax relief for seniors. I circled this part right here where it says the bill ensures that nearly 90% of Social Security beneficiaries will no longer pay federal income tax on their benefits. Then you can see further down, I underlined where it says the new law includes a provision that eliminates federal income taxes on Social Security benefits for most beneficiaries, providing relief to individuals. It then goes on to say Additionally, it provides an enhanced deduction for taxpayers age 65 and older, ensuring that retirees can keep more of what they have earned. Okay, so that's a lot to kind of unpack. So what does the OBBA actually do for seniors? And I included this in here because it's pretty important. So what it says is, this is section 70103 of the OBBA. You can actually read this. It's all online. You can typically pull it up. I try to read all of these new bills. I'm only about halfway through. I start with tax just because it impacts us as financial planners. But there's a lot of really interesting information that you may not be aware that's not normally, there's too much in it for it to go out in the news all the time. So basically it says in the case of a taxable year beginning before January 2029, there is a deduction in the amount equal to $6,000 for each qualified individual. A qualified individual is a taxpayer who's attained age 65 before the close of the taxable year. In the case of a joint return, the taxpayer's spouse, if such spouse has attained 65, is also included. This actually doesn't take effect until filing in 2029, so 2028 is what it says here. There are some different interpretations that say, well, now because it's 65, we're going to retroactively do it to this year. And so that both interpretations are currently, currently being bandied about. But this is the actual text of the bill, and it actually does say 2029. I think you're going to have to spend some time consulting with CPAs to figure out whether you're going to get that additional deduction or not. Okay, so what does the deduction do in practice? So here's just an example of Andre, who's he's retired. He's trying to figure out if he's going to retire at 62, which is this year. And he's heard that Social Security is no longer taxable. He got that email too. That is clearly a typo on my part. So he was originally going to retire at 65. Looking at the differences, he's going to get $34,000 per year if he retires at 62, and $42,830 if he retires at 65. So what's the net income for each scenario given OBBA? So we assume that he's only going to take the standard deduction. The comparison table looks a little bit like this, right? So at 62, it's getting 34,000. The standard deduction for 2025 was raised retroactively from 15 to 15,750. Does not get an additional deduction because he's not 65. And then so we can calculate the tax based on these two amounts. And you can see that the net income is actually fairly close to the gross income difference. So it's going to be about $5,000. All right, so that's essentially what's happening here. So there's still tax. If you make less than, if your Social Security is not taxable and your standard deduction gets you low enough to where you're not going to pay any Social Security tax, then you won't pay tax. But this does not mean that Social Security is not taxable. It is only that the standard deduction, there is an additional $6,000 deduction for people over 65. So that affects people who are 65 and older. There are a lot of people, actually, we were looking at this earlier today. It's going to be about, 17, 26, about 41% of people looks like they claim before 65. So they're not going to get this benefit either. At least until they turn 65. Okay. I see 1,600, the $1,600 dollar deduction. So if you look at the bill, it doesn't say it eliminates it, but it also doesn't consider it if you look at the OBBA. But if I'm wrong, and I'll update and send that out with the slides. Okay, This is just something like just for your benefit. A lot of people don't withhold Social Security tax. So I have a client recently who's been taking care of his mother. He didn't know where the Social Security money was going. Essentially, it's been sitting in this account. It's been grown. It's been sitting in a bank account. There's about $85,000 in this account from Social Security that's just been kind of running into that account. There was no withholding on that Social Security. And so not only is the client going to have to pay, is going to have to pay those taxes because they owe back taxes. They're essentially going to have to, there's probably going to be some penalties there. So this volunteer holding request form is something useful that you might want to talk to your clients about. But you can see there's only 4 boxes you can check. So if you've got a very wealthy client who is pulling a lot of money out of a 401k or an IRA or has several pensions, 22% may not be enough. But this is the form W4B. Okay. So those of you who understand foreign income exclusion, so foreign income can typically be excluded from your AGI. It is actually included in the provisional income calculation. So just give you a quick example here now. That a U.S. expat who's living and working in Singapore drawing U.S. Social Security. Singapore wages are 120,000 Sing, which is about $93,000 USD. So the expat has no other income sources. So that $93,000 is actually excluded from U.S. taxes, or can be excluded from U.S. taxes. You can also exclude tax from the taxes, but in this case, it's better to actually exclude it from income. But those expat wages are still includable for Social Security. So just because you're not earning U.S. income doesn't mean that it's not included in provisional income. So it's something that you have to think about. Okay, so that's federal taxation. It can get a little interesting with state taxation. Many states have phased out any taxation of Social Security, but we do have a few. And so if you're in any of these states, then you might want to consider, paying attention to whether clients want to move or not. And we'll have an example a little bit later on moving. So in Colorado, so this is relevant to Justin here. So if you're under 65, so this is a age 65 threshold. If you're under 65, up to 20,000 of your federally taxable Social Security benefits. So again, like what is actually taxable, are not going to be taxed by the state of Colorado. And then for 2025, if you're 55, 64, so survivors who are receiving some of this can deduct all of that Social Security income if their AGI is $75,000 or less, $95,000 or less if they're a couple filing jointly. And then if it's in excess of those thresholds, so if it's above 75 individual, 95 joint, then the Social Security tax is going to be, or the Social Security income is only 20,000 is going to be excluded. And then if you're 65 or older, then there's no problem. So, in conjunction with OBBA, 65 seems to be much more of a magic age than it used to be in the past, despite most FRA either being 66 or 67 currently. Okay, in Connecticut, about 25% of benefits can be taxed. So one of the things to kind of think about here is the interaction between the state and the federal. And so if your AGI is above 75 here, again, AGI is not the same thing as provisional income. So just because, so sometimes people will use planning strategies. Well, like, oh, we're not going to withdraw any money so we can keep your AGI down. And in this case, it might make sense. Same thing here, married filing jointly. Minnesota is fairly unique. So this is 2024. I didn't actually have updated numbers for 2025. I assume those of you in Minnesota probably do. So if the AGI is 82,190 or below for 2024, it's exempt. So your Social Security is exempt. But if you have phases from 82,191 to 118,191, and anything above 118,191, it's all going to be taxable. So this is again that interplay between AGI and taxable income. So whereas the federal government is looking at provisional income, most of the states are not. They're looking at AGI.
And Mike, let me just interrupt here. I'm noticing, I'm learning some things here, and I'm noticing that it's crucial here that taxable income, federally taxable Social Security income, is not changing with this OBBBA thing, right? Because it's really just an extra deduction. So it's not like you're knocking $6,000 off taxable income, taxable Social Security income for these state purposes.
No, it's a good question. No, yeah, you're not knocking it out. It's not changing that.
Right.
And so, I mean, it's not that many states, so that's not it's not a huge thing, and state tax is not like a massive amount, but sometimes, people care about that, and it can add up when you start talking about like things like pensions, and sometimes pensions are exempt from income, but if they're included in Social Security, and so there's a lot of really complex planning opportunities, when it comes to, I think OBBA, what it did is it created basically some more opportunities. And in fact, most legislation, that's kind of what it does. It just creates more opportunities for planning to figure things out. But
yeah. And I've noticed too, there's been a big trend towards states getting rid of taxability of Social Security. So I think I wrote an article, I don't know, 4 or 5 years ago on the Kitces blog, where that list was, I mean, it might have been 12 or 15, like it was much longer. So there's been a real, somebody's lobbying the states successfully to get rid of. So I don't know if it's the AARP or something, but there's definitely been a shift. And I think you mentioned West Virginia is, phasing out. There's some of that stuff happening. So
yeah, I mean, we'll get a second, but it's interesting what different states do, and then how much revenue comes from Social Security, and the reality is that, like, if you're taxing it, taxes are all about incentives. So this is, I mean, we all know this, right? We're all planners. So taxes are about incentives. And so if you want somebody to do something less, you tax them more. So if you want people to live in your state, you tax them less. So if this is if you want retirees, you're probably going to eliminate Social Security tax.
Yep.
I'll actually just run through these. So New Mexico, they have these thresholds are just no tax on AGI below 100,000. So these are pretty high thresholds. So it's kind of nice, 100 and 150. Rhode Island is also high, so no tax if income is below 104. It's just like any other sort of thing. Like if that benefit only applies here at full retirement age, though. So, and both spouses have to be at full retirement age in order to receive that benefit. So they do pay Rhode Island income tax if it's below 67. One of the things that we've been talking about, and what Justin talked about last week, was talking about early claiming and how early claiming can be beneficial. And what we're finding in some of these laws is that there's actually a tax consideration here. So yeah, maybe claiming early makes sense for a lot of people, but if you're in a state that's going to tax Social Security, it is something that should be considered. It still may be the best thing to do, but you may want to consider it. Utah is another interesting one. They actually look at modified adjusted gross income. So they're adding back in some of those deductions and credits that you would, that gets you to a little bit lower taxable income. And so for them, they're looking at Magi of anything over 45,000 they're going to tax for single filers, and anything over 75,000 they're going to tax for married. I link in this slide, there's a worksheet, like your interest income, your municipal bond interest. Those are things that you can go through this worksheet, and this worksheet will can potentially provide you a credit to offset some of these taxes. So Utah's situation here is a little bit more complex when they're talking about, when we're talking about taxation. Okay, Vermont, this is interesting too, because Vermont has, they have some places in Vermont where the income for retirees actually exceeds these thresholds, or there's a significant proportion of the population where the income exceeds these thresholds. There's a good bit that's below as well, but these are fairly low as far as thresholds for what's not taxable. And so if you're claiming IRA income, if you're claiming, 401k income or other pensions, et cetera, then, you're probably going to see some tax in Vermont. Okay, West Virginia. It is actually, the way it's set up, it's pretty complex, but essentially in 2024, it was, this percentage was lower, but 2025, 65% of income is exempt. And then in 2026, it's 100% going to be exempt. So it'll be completely phased out. And this is part of trying to actually get a few more people into West Virginia. So if you can get if you want more retirees in West Virginia, then, like we said, you're probably going to make Social Security not taxable. Let me just kind of go through here. Hey, if it's answered, it doesn't go into because I'm going to go into some scenarios next.
Yeah, I've knocked out a few of the
Okay.
questions, but yeah, maybe to hit a couple that are related to stuff we've already talked about. Some people were a little bit confused about phase-ins and phase-outs of the OBBBA stuff. And there are some slight differences, but yeah, a lot of things are gone by 2029. I think the SALT might be 2030, that state and local tax deduction, which is not a topic for today, but just. And then there's a bunch of weird stuff around inflation adjustments, which is actually worth mentioning in the context of Social Security taxation too, because those thresholds that Mike just mentioned, they've been there. Well, the 50% threshold was there from 1983. We went over that last week. That actually the Social Security system has changed a lot over the years. Sometimes like we learn about it, you do your CFP or something and you learn about it and you think, oh, that's how it's always been. No, it's changed a ton. 50% was 83. Correct me if I'm wrong on that, Mike. I don't know. And then 85% came in the 90s. I think it was 93. So, and those numbers have been the same since then. So I just did some quick math. The 25,000 is one of them. Is that right?
Yeah.
I think that would be like 80 some $1,000 today if it had been adjusted. So somebody was asking, it seems like most people don't get taxed. Well, way more do now than did back then, I mean, and then 85,000 in, 93 in today's dollars would have been like 100,000. So like really what you would have been talking about is like an 80 to $100,000 thing, but instead it's, 25 to 45 or whatever it was, 44,000. So and the OBBBA stuff is not adjusted for inflation. So it's $6,000. I don't believe I looked for it. There's other ones where they get like a 1% bump a month. It's just it's a mess. But yeah, essentially that answers some of the questions people have. And for those of you who are asking, the deduction, all that stuff is already in Income Lab. So if you have plans in there, it's already getting shown. But again, you'll only see it through 28, and it might be phased out. There's MAGI phase outs, as Mike said. So again, it's a total mess, but it's all in there, so it'll be calculated for you.
Let's see. Ren said, "Do you mean foreign income to be a pension?" No, like if you're earning income in a foreign country, so say you have a job in the UK or something, and a UK company's paying you, I'm saying that that is wages that would be included in provisional income. So not necessarily a pension. So pensions are included in provisional income.
Yeah. And
Uh,
people were asking about MAGI in general. Usually that's just AGI plus tax exempt income. I think there may be a few places where I think for Obamacare, ACA credits, it might be different, but
ACA credits, and then I think there's yeah, it's deductions like IRA deductions, things like that get
yeah,
added back in.
yeah.
Uh, yeah, well, you should report your foreign income because they require that. So the Social Security scenario where the standard deduction wasn't added, actually that person 50% of their at 62, 50% of their Social Security was taxable. So few individuals, these low income, it seems almost impossible to avoid taxes. It is pretty, it's just like that's what Justin was saying, I think. Like it's just really, it is really hard to avoid taxes. We're going to go through actually a scenario where maybe it's possible. It's a very curated scenario, and it would be a very specific situation where you could essentially avoid taxes. So this is I know that I've got like, there are a lot of people who are, Roth conversion fans. I think I can't open up LinkedIn without seeing, 6 or 7 posts on Roth conversions, in a day. So I know they're very popular. So we're going to talk, briefly about this Roth conversion scenario. And this is a situation that may not pop up that often, but it's potentially small American, right? So this is a administrator at a small law firm. She's been working there for 30 years. Boss says, "Hey, look, I'm going to close this firm in 10 years. So, figure it out." They didn't have a retirement plan. So she's been putting money into an IRA, maxing as much as she can and investing aggressively. And so she's actually managed to accumulate 1.25 million in that IRA. And she currently earns $70,000 a year. So she looks at her Social Security statement. She's like, well, how much am I going to get from Social Security at age 64? Because that's how old she's going to be when the law firm closes. And it looks like she's going to get about 24,500. And these numbers are what they are by design, just for illustration purposes. It's not always going to be this cut and dry. In fact, it's never going to be this cut and dry, as you all may know. So in this situation, we're saying, okay, look, let's convert the IRA money over a 10-year period to Roth. And so overall, what's going to happen is she's gonna end up paying about $665,000 in taxes over that time period. Account's going to grow. She's going to be, doing the conversion. So it's going to cost a little bit of money. The tax treatment of the withdrawals is going to be tax-free. And definitely just paying the taxes now. So if we look at if there's no conversion, if she just keeps it in the traditional IRA, and let's assume basically that she's going to be getting taxed around based on the withdrawal schedule that I chose, she's going to be getting taxed at about 25% between federal and state, and then 85% on her Social Security on 85% of her Social Security, not 85% of her Social Security. And so what we end up with is, you can kind of see, you just look at this right here. Oh, well, it's a $68,000 savings, but what I did here too is, a lot of times what happens is when people compare these Roth conversions to no conversion, they're typically not taking into account, they're not doing a present value calculation. So in this case, it did a present value calculation. And when you do that, it is still better for Jan to actually convert instead of paying them over time, because she's not going to pay any taxes on her Social Security. And so basically she'll just spend her entire retirement not paying taxes. So that savings is about $68,000, which is not a huge amount of money, but like when we think about, $60,000 is about $68,000 is about 1 year of her salary. So this is a situation. I mean, obviously, this is designed perfectly so that it comes out the right way. But it is something that you would want to analyze. You would want to spend some time with clients and say, okay, does a Roth conversion make sense in this case? And in this case, this particular case, it does make sense. Okay, so I did mention a little bit about that there's a possibility that a planning scenario could include, like, where does somebody want to live when they retire? And so I created this scenario where basically it's Joe the veteran. And so Joe is a retired U.S. military veteran, and he's trying to figure out whether he wants to live in North Carolina or Montana. He's got a U.S. military pension of $70,000 per year. Which would contribute to his provisional income. He's got Social Security benefits, which are $41,000 per year. So essentially, he's going to pay tax on 85% of his Social Security, right? Those two numbers together puts him well over that threshold. So the question that Joe wants to know is, of these two places, let's say that he's got family in both places. Of these two places, which state is the most advantageous for him to live to? And this is actually true. Property taxes are about the same, slightly lower in North Carolina. But for the most part, that would be a consideration as well. You would want to consider all those sorts of taxes. And so what sorts of questions do we need to ask, right? So, well, we're going to know how does North Carolina and Montana each tax Social Security? We know from the previous set of slides that Montana actually just mirrors the federal government. So they're going to have the same thresholds. And then how does North Carolina and Montana tax military pensions? And turns out that Montana taxes both Social Security, so they tax it the same way they do federal government. And they also tax military pensions. And so in this case, if you're looking at the same gross income, the pension is going to be taxed in Montana at it's going to be taxed around, it's going to be about $3,070. It's going to be about $2,021 for the tax on the Social Security. You're going to pay the same federal tax because it's the same scenario, right? And in this case, it's about $5,100 difference. So it's, that's not nothing when you're talking about annual taxes. And so in this case, obviously there's a lot of other considerations. It's really muggy here. I live in North Carolina. It's really muggy here. Montana is, it's big sky country. There's a lot of nice outdoor experiences, although my understanding is it's getting a little bit more crowded there. Real estate counts as well. So yeah, how much are things going to cost? But in general, from what you pay your various taxing agents, it's going to actually be better to live in North Carolina in this case. So it's definitely something to consider when you're talking about, so when we talk about cross-border planning, we're not just talking about foreign countries, we're talking about states as well, because there are differences in states as well. All right. Okay, so a few other issues. There is, I don't know if you, Justin, I don't think you talked about this last week, but there is the consideration for reductions in your benefit. So if you are not at full retirement age, it was unclear how this would fit in any of the other weeks that we did this, but I did want to include it here. So if you retire early, and you're still working, uh, you can actually have some of your benefits reduced for that year. Now these benefits are added back in later, so you don't have to worry about, like, one of the big concerns with clients is always like, I paid in, they owe me, and so this would feel like it's being taken from them. But they, consider the fact that they're actually going to get that money back. So in this case, this is Jesse. This is very similar to a situation that I had with a client where she was collecting Social Security, and all of a sudden her benefit was reduced because she started working for her son, making $30,000 a year. And so in 2025, that benefit would be reduced for every dollar, for every $2 over 23,400, it would be reduced $1. But then once Jessie reaches her full retirement age, that goes away. There is one quick caveat: the month before you turn 65, that $23,000 number jumps to I think it's close to $61,000. It's around there. And for some reason, it's just built in that it's that month before you turn 65. But then thereafter, it's that threshold doesn't matter. So when you're thinking about from a planning perspective, if in this case, the client could kind of control work schedule to keep that number under a certain amount, maybe even at 64 have do some work, and then have the son who she worked for push some of that income into the next year thing. Maybe
Just
a bonus or a raise or something in the next year. What's that?
a quick comment on that, because I saw a few in the chat. I think it's the year that you hit FRA. So
Yes, it's the year you hit FRA.
67 for most people, like you said. There's still a few who are at 68 and 10 months, I think, but in like a year that'll be over. So it'll all
Be 66 and 10 months, right? Like
60, sorry, 66.
it'd be great if somebody was 68. That means we're actually doing the right thing, moving that up a little bit. But yeah, 60, yeah, at FRA, so 66, 67, it's that threshold jumps for the just before the month before they turn.
And just if this seems totally arbitrary to people, the concept is they're basically saying, like, Social Security is a retirement benefit and you're not really retired, right? And so that's what the whole take it away and then give it back thing is all about. Like,
Right.
because sometimes you look at this stuff and you're like, what? Who came up with this? What is right? But that there is like a conceptual reason that they have.
Yeah, I think my father is still working. He's 73. But that was a situation he claimed early, and then was just really confused as to why. I mean, he's worked his whole life. He's like really confused as to why his benefit was so small. And it was because he had a great salary working for the federal government. And so not only was he getting, he's one of those folks who, like, every tax dollar is a knife wound. So not only was he getting taxed, then his Social Security is reduced. His provisional income is over the amount, so he's getting taxed on 85%. So it was like this. It was this big issue, but like he didn't realize that he would get that back. So,
and this is another place I think where policy has changed over time. In this case, actually for the better. So I believe at one point there were earned income reductions, I think for everybody. Then it got pushed back to that ended in December of your FRA year, and now it ends at FRA like that actual month. So this is actually a place where it's gotten a little bit nicer to people.
Yeah, I think it was originally, like, no matter how much, not originally, but like I think it was.
That's right. So now there's even these thresholds, and like you said, the threshold in your FRA year is much higher, like 3 times as much, and it's $1 for every 3 instead of it for every 2. So it's not that things have always gotten tougher on people, although that's often true.
All right, so that's something to consider if you have a client who's a side hustler. If you recall the example earlier where I was talking about the person who was in, living and working in a foreign country, obviously that person they were full-time employed, and so they would have a reduction as well. In that scenario, I didn't do any reduction calculation, but I thought that it was important for us to kind of talk about here. There's a couple of other things. So actually, before I get to Jamie the Unbalanced, so one of the things that I think I want to touch on, because I didn't go into too much depth in it when we were talking about the states, is the fact that there are these different thresholds of, both people have to be a certain age in order for some of these benefits to kick in. Obviously, the one that is currently germane is the OBBA one, where you've got the $6,000 deduction. You might have somebody claiming, if both people are going to retire at the same time, but one person's 62 and one person's, say, 67, that can create some potential issues. And it's not so much that it should prevent them from retiring, but it is important for them it's just information for them to know. It might not be enough to move the needle, but it might be enough to where people are like, well, maybe I'll work another year or two because, I don't want to give that up. People are weird. So when we talk in week 4, we're going to be talking about the, psychology behind a lot of this. And so I say people are weird. People are different. And so people have different ideas about what makes sense. And so even though it may not even be that big of a deal, you having this information and being able to transmit that information to a client, I think is incredibly useful, and it just demonstrates value. Okay, so this is a scenario where somebody's got multiple income sources, multiple income streams. So receiving 20,000 in Social Security, 25,000 from a pension, and 15,000 from an IRA. And so that's a provisional income of 70,000. So there's a couple of different things to kind of think about here. Is that 20,000 in Social Security, if absent this other income, would be non-taxable, right? It would be completely non-taxable. The $25,000 from the pension, one of the things that this person's 68, but one of the things that might be important to think about is if you've got a pension that will continue to accrue, it may make sense to claim it a little later, depending on how much it grows. If it's like Social Security, you might want that 8% or something like that. But it also kind of plays into the potential for claiming early. If you've got enough sources of income, then maybe you don't care as much about the small amount of tax that you're going to pay here. So even at 85% of the 20,000 being taxable, is it that big of a move? I don't state here that this person has a Roth IRA, but if they did have a Roth IRA, they might be able to reduce their provisional income. That is not a provisional income of 70,000. That is a provisional income of 60,000. So sorry about that. So anyway,
that was just to make sure everybody was paying attention. I can tell the professor in you. Yeah.
I have done that in the past. I don't, this was totally, I messed this one up. But anyway, the idea is that if you did have some Roth, then you could potentially, especially if Jamie was married, you could potentially reduce the amount that is taxable. In the amounts we're talking about, oh, somebody did catch it actually. Yeah, Robert, good catch. So what was I going to say about that? Basically, some of these amounts are pretty small, and so when we think about financial planning clients, I mean, we're usually not talking about, trying to save somebody like, $360 a year in taxes. Um, I, I think, hang on a second. So provisional income, I just want to make sure we're clear on something. Where was that? Oh, somebody else answered it. Okay. Anyway, the idea is that you can be more optimal. And one of the things that as financial planners we do have to think about is, well, is optimal best? And spending all this time trying to figure out whether a small amount is useful to a client may not be the best. Now, if we go back to Jesse, potentially it's something that could save some significant money. Or if we go further back to like talking about where to move, I mean, that can be depending on what people's sources of income are. This can be a lot. Now, not everybody works with military veterans, but military veterans need planning too, and many of them have very nice pensions. Retired 06 is making about 10 grand a month from their pension. And if they're in a tax exempt state, then that can be pretty hefty. I think, yeah, there we go. So we can answer some of these questions since we've got 8 minutes left.
Let me, there are a couple questions about like where to see this stuff. Well, maybe we should knock out the FRA thing first. So Mike was just talking about the whole withholding when you're working before full retirement age. They don't just give it back to you in a lump sum. If you read the Social Security's administration on this, it can be very confusing. What they really do is they say, and actually they don't reduce your benefits proportionally. They just withhold checks. So like if you got a $2,000 check and they're going to withhold $5,000 that year, you're just going to skip the first check, skip the second check, and then get half the third check. So what they do then is they say, well, we're going to add up all the months where that happened and pretend you actually filed that much later than you really did. So if you skipped 10 checks over that period at FRA, they'll just say, well, what would your benefit have been if you had actually filed 10 months later? So it's not a lump sum, here it is back. It's like an actuarial adjustment is the best way to think about it.
Yeah. They adjust it based off of mortality tables.
Yeah. No one should remember how that works. Just know that the benefit goes up at FRA and they just kind of pay it back to you over your lifetime.
So some of you who might have engineering clients may appreciate that answer because they will ask. They will say, "Wow, do I get a lump sum?" Or so I think you can explain it that way.
That would be nice, but no. Let me share for a second here, and I can show folks. But people were wondering where that taxability is calculated in Income Lab, so I just wanted to share that one. And this is actually a good example also of what Mike was going over about Roth conversions. Mike, do you mind unsharing and I'll...
Oh, yeah. And Joseph, real quick, to answer your question, the discount rate I used was the inflation rate, which was, I think I used like 2.72 or something like that.
So, all right. So if you're in Tax Lab, for those of you who don't use Income Lab, this is where you do like tax analysis, compare a bunch of strategies for how you take income out over your retirement. You do Roth conversions, all that stuff. Okay, so I'm zooming in on converting up to the 22% bracket. And you can see taxable Social Security versus non-taxable Social Security. And Roth conversions are obviously going to have an effect on that. I went down and I'm showing the year by year table, and you can see taxable Social Security we're here, and essentially the advantage, one of the advantages here is, yeah, I've got pretty high taxable Social Security during my Roth conversion years, right? In 2039, I'm at 51,000 versus 9,000. But then as soon as I start spending from Roths, that kind of flips. So um, that's where you'd see that. So that's all calculated for you automatically, and it definitely is one of the things on the ledger, right? If you're trying to figure out if Roth conversions make sense, one is, well, if I live long enough, then I'll be taking home more of my Social Security. I know people mentioned IRMA as well. That's also certainly a factor. Um, the IRMA brackets, and if you look at people were doing a great job handling some of these. They noted that there's a 2-year look back on IRMA, so that's all handled for you automatically. All right. You see any others here that have a lot of?
Um, this taxation for a single taxpayer change with age, with regard to some of the states, yes.
Oh, that's true, but not the federal thing, which
Kind of, right, with the deduction, but not
right.
really, right?
But
Like,
yeah, and there was a lot of commentary on this as well. It's
yeah,
it's essentially being marketed as a reduction to Social Security, but actually, in a way, it's better because it just reduces any income,
yeah.
right? So yeah, I mean, you
I
could
mean,
look at it.
it's better, like you could almost call it like a reduction for retirees, I
It's just
think,
a retiree
most states.
deduction,
Because
yeah.
if you think about people, maybe there's somebody who doesn't, maybe they didn't pay into Social Security. I have a number of we'll talk about divorce next week, actually. One of the scenarios we're talking about is like this lady did get married and then got divorced again, so she has no claim on Social Security anymore. Um, but that deduction still helps her, even though she's not getting Social Security.
Right, right.
Online federal tax estimator tool, Income Lab. Um,
You
is
definitely estimate your taxes. I don't know if there's a federal one. That's a
is
good question.
online.
Um, there probably is. Yeah, and I was also trying to find out if you can submit that withholding form electronically. There are some things you can do electronically on the Social Security website. I don't know if that's one of them.
You can do it. You have to do it when you're claiming. And so sometimes, so if I'm claiming with a client, if I'm walking them through it and they agree to do the ID.me, because that's the other thing, right? Like if a client doesn't want to do that, forget about it. Like you're doing all the manual stuff. That's less and less of a problem these days. Although, cybersecurity experts do have a little bit of an issue with ID.me. So clients aren't completely crazy in that sense, or not crazy at all, actually. Um,
So I think we're wrapping up. Please come back in the next couple weeks. We're going to keep doing. We've got like Mike said, we've got um, basically all the complicated stuff next week: survivor benefits, spousal benefits, divorce, and then we're going to really dive into the psychology around claiming, which will revisit a little bit of the stuff we did last week. And go over really some reasons that rules of thumb like wait till 70 or everybody claim at 62 they just don't hold water. It's really like it's much more complex than that. So those are going to be great. And we will send out links to this recording, links to the slides, and make sure you fill out the questionnaire that you'll get when I close this webinar, because that's how we're going to be able to put your CE credit in. Somebody was asking where the questions are. We'll leave that as an exercise to you. You actually get the credit just for attending and being a good audience. So, um, any uh, any questions that we didn't get, we will try to take a look at those, and if there's something specific that we can address for you, or when we have time in future sessions, we'll try to revisit some of these if they fit the topic. But with that, I want to say thank you to Michael Kothakota and to everybody for for joining us today. Great session. Thank you, Mike. I'll
Yeah,
see you
no, it's
again
been
next
great.
week. Appreciate it. Take care,
All
everybody.
right.
Bye-bye.